Hey everyone, thanks for joining in. We're going to kick off here in just one moment. All right, let's get this day kicked off. Welcome to our first partnership webinar series. We're here with the phenomenal Lorraine McGregor, who is the CEO of Spirit West Management. And she is a highly accomplished senior business growth consultant, entrepreneur, strategic partnership builder, and has been a phenomenal guide and operations leader for startups. She has played a lot of various roles in helping companies that range from $3 million to $80 million and helping these high growth startups with mergers and acquisitions, turnarounds, and reorganizations. She's done over 300 engagements across North America. And today she's going to talk to us a little bit about how to set up your defense tech business to be acquired. So I'm excited to hand this off to the phenomenal Lorraine McGregor and let her tell us a little bit more about what we need to do to get our businesses acquired in the defense tech space.
Joey, thank you so much for having me. What a great introduction. That's super. Well, I already moved one slide too far. Okay, so I am really passionate about this topic because I want to level the playing field for everybody here. And that is the most important thing, to know how to play the game, but also to how to level the playing field. I love helping companies understand what it takes to be acquired, and strategically and operationally. So in the same way that you're probably very passionate about what you do and what your company's all about. So let's join our passions together and figure this out. And the first question is a poll question. Do you have investors in your business? So answer yes or no. Let's find out what you have to say. Key question here so that we have the right context for this presentation. Couple more seconds, and do we have some answers?
You have 3 out of 9 who responded yes, and 6 out of 9 who said no.
Okay, so I have some good news and bad news for you. All of you that answered, thank you. All of you that answered yes, I'm glad to hear you have investors, but all of you that answered no, I want to tell you something. You are an investor in your business. You are the one that should get a return on the investment in your business. And that's what this presentation is all about. So actually the right answer is yes across the board. You are an investor. So this is the hat that I want you to wear for the rest of this presentation, because I imagine you have poured your heart, your soul, and probably your money into this venture, and you need to get your return on investment. And this is how to do that. So let's look at the next poll question related to this. So I'm just going to close that. What do you think your investors' top expectations are? You know, and there's probably one. I only want the one. So growth in their investment, influencing the direction of the company, growth in revenue and number of contracts, return on their investment, be associated with cool people doing amazing things. I mean, there's probably all of those things, but what do you think the top priority is? Okay. Do we have some answers? Hard question, huh? Growth in revenue and contracts, return on investment, be associated with cool people. I like the person who answered be associated with cool people. Yes, you are all cool people. The number one thing that they should care about is return on their investment. Yes, growth in revenue will help you part of the way to get return on investment, but not all the way. And that is the big key issue here. Return on investment means strategic and operational returns. So now that I've confused you, let's move on and get the answers going on how to play the game. So here's our agenda, but I really want to tell you what the main secret of this game is while you look at the agenda. The main secret is that in order for your company to be acquired, you have to become the puzzle piece that your acquiring company is looking for to solve their growth problem. No, that's a mouthful. What does that mean? Well, companies are only buying businesses that actually set them up for the next stage of their growth. And if that's not your company, even though it's successful, even though you've got revenue growth, even though you've got growth in the number of contracts, and you've got a cool team and you're doing amazing things, if it doesn't solve their growth problem, the deal's not going to happen. So now that I've revealed the secret to you, I'm going to show you why and what to do about that so that you can become what they want to acquire. So yes, I've been doing this with my husband and business partner for a number of years, and we help improve valuations by 2 times, even 4 times from the time we meet company owners, because we know how to fix the red flags that makes growth hard and selling the business challenging. And those 2 things have to go hand in hand. You have to become saleable and grow to the next level at the same time. And when you unite the 2 things strategically and operationally, you get that boost in valuation and the interest of your ideal buyer. So we work across North America and the Caribbean. Our top referrers are other M&A advisors who get asked all the time, hey, sell my company. And they say, you're not ready because you don't fit that puzzle piece. And of course, wealth advisors, because they want you to accumulate some wealth, not just spend it, and our previous clients. Whoops, back. So why this investor mindset? Well, when do you make a return on your investment? And I'll tell you the answer is when you sell, not before that. Your company as a private business is not liquid. Even if you give options to employees, those options are not liquid. Even if you think that you have VC as investors, that investment is not liquid until somebody comes along and says, okay, we want to either invest in the company and by buying some of your shares or acquire the entire company. So you have to think about today, not when you're thinking, maybe I should sell. You know, how long you're willing to wait for that return on investment and how much you're going to keep forking over into the company instead of turning it into, you know, diversification into other assets. And there are opportunity costs, there are risks that are acceptable and not acceptable. And those are all personal questions. Those are all things that activate your risk intolerance or draw a line in the sand and say, I can take this much risk, but not that much. And often until we've taken too much risk, we don't know where the line in the sand is. And becoming much clearer about what's important to you and what you can tolerate individually and with your other co-founders is key to becoming, having the investor mindset. And then the last piece is to be able to look at your business from that investor perspective so that you can see the very things that I'm about to tell you about that they see in your business that makes it hard to acquire it. So this whole question that you want to think about today is, should your business become an asset? That means it can be sold to someone else and they want to buy it. Kind of need to have both parts of that equation. So why would you want to be acquired? So 4 compelling reasons. So you've just learned you're an investor in your business and you may want more than just your salary, just your dividends as evidence of return on investment. And maybe some of you aren't getting a salary yet, or maybe you're not paying predictable dividends. Crucial that you turn some of that money into other investments so that you get a return another way, other assets that help you build resiliency and diversification into your own personal portfolio. Another reason, you know, when you are in a capital intense business, you need a lot of resources. Your customers are big. You have to deliver on your customer commitments and it costs money to grow the business to the next level. So maybe you need some more investors. And when you make your business saleable, it is also attractive to investors who just want to buy a chunk. Another reason, you've got to scale up. And when you're scaling up, it's a different set of skills rather than just operating a big business that is consistently delivering on results. So your strength and passion might be more about scaling up than running a larger business. So you need to bring in someone else or many someone else's that have different strengths than you. You never want to try and add one more strength that isn't your strength to your bench. And the last thing that's super critical is buyers are looking to acquire that growth investment that's going to solve their problem when it makes sense to them. Not when you're ready, not when you turn a certain age, not when your business has crossed a certain threshold. They look all the time. And that means that if it's important to you to get a return on investment, you always want to be in a saleable state. So here's what we're looking at. And I don't want to bring up the poll question quite yet. Let me explain this chart. So this is the number of business owners here, 3.3 million, that have employees more than between 10 and 100. 3.3 million companies. This is the percent that's over 50. Now, why is that important? Well, most people think, oh, when you get over 50, you should probably think about selling your company. Banish the thought. Retirement is irrelevant to this whole thing. But there is this chronic need to survey these people, this 1.782 million people, to find out when they're going to sell. And this idea that there's going to be this massive transition of boomer businesses that are suddenly going to be acquired by other companies. And so they keep serving all of these owners, and they all say, I'm going to sell in the next 5 years. And this is the actual number, 18,072 that actually sell in a given year across all industries. Small number, huh? So that, in contrast to the fact that this year there's 5 trillion looking for acquisitions. So given this demand, is this a buyer or seller's market? So let's look at that poll question. Is this a buyer's or seller's market? Catalina, are you able to bring up? There it is. Great. So is it buyer's or seller's market when you own a business that you want to sell? So given the supply of companies and the trillions looking for acquisition, do you think this is a buyer or seller's market? And who has the leverage? Because, when it's a buyer's market, they have the leverage. When it's a seller's market, they have the leverage. Couple more seconds. Do we have some answers, Catalina? Kind of split. Buyer's market, seller's market. Yes. Well, this is a bit of a trick question. So because only 18,000 companies ever sell in any industry, it is always a buyer's market. That number doesn't change much, even in hot years when there's that much money looking around. Buyers want what they want. So there's high demand. Listen to this. There's high demand for the companies that have made their businesses saleable strategically and operationally, and low demand for companies that have not done that. So you could put your company up for sale, as many do, and never find a buyer. And there's the evidence. I've been tracking these numbers since 2008, by the way, and they don't change. So next poll. Okay, we got that one. So what are we talking about? Buyer types. Well, there's many types of buyers, and they each seek a unique value focus. What does that mean? Well, they buy because they're trying to solve a problem for their growth. So there's strategics that are other companies, and they buy their competitors or they buy something adjacent, but it's all got to be something that is that puzzle piece that fits right into their ecosystem and solves their growth problem very quickly. So 65% in aerospace and defense. Companies are bought by strategics. Private equity is only about 25%, but I'd say that generally across all industries, strategics buy more companies and private equity buy less. So private equity is actually more interested in A&D than in normal years. And I break down private equity into those that are doing 100% buyout or a majority stake. So, but they're not operators. They're there to fulfill the investment mandate of their fund. Or they are the smaller group, they are operators, meaning they run their own businesses. They want to take a majority stake or buy all of it. And or private equity that are just doing minority stakes and they're not operators. Very few are interested in minority. Why? They want control. They've got their money from somewhere. They have to return that investment to their funding group. So they want to make sure that the business gives that return. So they buy a majority. The most comfortable situation for sellers is to have this type of private equity, people that have been operators and understand the challenges of running a business. And so let's dive into that. What are they looking for? And this is financial buyers only, meaning private equity. They're looking for financial fit first. If your business isn't growing 30% year over year as a minimum, they're not interested. So say you've got that, and there's the risk and the reward. How much more work do we have to put into this business for how many more years until we get return on investment for our fund group? And strategic fit. Private equity is often buying what they call a platform bolt-on, such silly language. What it actually means is same thing as strategic. Here's our business, here are all our companies. Where can we add another company that would have synergies with all the other companies in our portfolio? These other three areas, not so important. But to strategic buyers who make 65 to 70% of all aerospace and defense acquisitions, strategic fit is everything. You don't get strategic fit, none of the rest is important. But they're looking for the X factor that's going to solve their problems, the green lights that tell them, hey, this is going to be exactly what we need. So there's a fit in the marketplace. It opens up a market for them that they can't get into on their own, in the right geography to create synergies with their customer or with their manufacturing. Cultural management fit. How well is this management team going to fit into our culture? Do they need to, can we be like the Borg and just, accumulate the company and synergize it into our business? Or does the company have to stand as its own separate brand in order for the fit to be right, to get the strategic value out of the acquisition? Financial fit, is it hitting numbers? Does it have the gross margin we're looking for? Yes, gross margin is the number one thing they care about, not so much revenue. And then they'll evaluate risk reward fit. So you can see that M&A deal makers at the strategic level are juggling a lot more cues to tell them whether a company is going to work for them. So why is all this important? Well, this is your ticket to maximizing your opportunity. Your business has to fit into their ecosystem. It has to add the value they need to go to the next level, and it has to solve their growth problem faster than building it in-house. And in order to be all of that, you have to do the work strategically and operationally to fix the red flags that say no to these buyers. And it takes a few years for the evidence of the changes you're making to actually land in your income statement and balance sheet. And so there's a trend, growth in revenue, growth in gross margin, growth in the innovation that you're preparing. So we have a couple of examples here. 3 acquisitions that were made in the last few years. Blue Force Technologies was recently bought by Anduril. Why? Because Anduril needed their innovation. They created Force 5 semi-autonomous drones, and they did it in such a way that it fit into the Anduril's technology platform. So they were doing a lot of cool things at Blue Force. They optimized themselves, and Anduril went and looked at all the people doing that work and said, this is the company that creates the best fit. Blue Force, there might be better companies doing this, but Blue Force checked all the boxes. So that was a strategic acquisition. Excuse me. Franson Engineering, they were bought by a major public company who was trying to get into the oil sands business. And the Franson had, before we met them, had many industry niches, and they needed to have one niche. because why? This public company needed to get into the oil sands business, and Franson won a contract with Shell. The public company couldn't get in with Shell, despite years of trying with their business development teams. Franson specialized in doing small projects for the oil sector, and that specialty and that innovation and that key contract was all the magic it needed to attract this company, this public company, out of the blue. And they, when I met them, they were worth 3.2 million. When we were done, they were worth 12 million, and their deal was 18 million. Massive change in valuation. Spaceflight, so they were just recently bought by Firefly. Firefly, well, spaceflight is an interesting thing. They're kind of the Uber of packages to space. And, you know, they thought that that's why they'd be bought, but actually Firefly bought them for their manufacturing and their ability to disassemble and assemble things very quickly in a single environment in a geographic area they wanted to sell in. So 3 totally different reasons for an acquisition. So what we do is we help you figure out what reason is your company would be acquired now, even though it might not happen for a few years, so that you're on the path strategically and operationally and with your team to become exactly what your ideal buyer is looking for. So let's talk a bit about valuation. You probably, you know, this is the sexy thing that everybody talks about. Somebody sold for X, and maybe I can get that too. So we all have a human tendency to become attached to numbers. And I want you to stop thinking about what your company is worth today and what your company might be worth tomorrow, and instead think about being that perfect puzzle piece, because what you're selling is the past. It'll be everything that you've built up. That's the legacy you're leaving. But buyers are valuing the growth. This is what they're paying for. They're buying the future. They're not buying your past. Yes, your past builds the foundation so that you can have a future. But without that future growth, without that trajectory, they don't see the fit. And so if you get attached to what your business is worth today, we can't test your valuation gap. We can't test risk tolerance. When you understand that you let go of what it's worth today and aim for something, which you may get, or you may get more, you may get less, you avoid this psychological problem called loss aversion. And that's being attached to a number like, I want to sell my business for $40 million. And then no other number will satisfy that dopamine that you have going in your brain, waiting for that $40 million, and you feel lost. So this is the number one reason that most company owners can't sign on the dotted line at the end, because they think they've lost something, rather than thinking they're getting an amazing deal with a cool company that's going to take them into the future. So stop thinking about it, what it means, until you get an offer in the letter of intent and buyers actually name the price. You don't. So let's look at valuations and where aerospace and defense were in 2022. That's not to say that that's what the number is going to be this year. So valuation is based, one method of valuation is based on your earnings times a certain multiple. And so these numbers you're seeing here, 15.9 times, is times the earnings. So it's, your revenue minus the cost of producing your product or service equals gross margin minus your expenses of running it. And then that's left with your profit, earnings before interest, tax, and depreciation. And yes, so EBITDA. So these numbers is the amount that was paid for companies that sold. Any company that didn't sell can't rate this multiple valuation. So you can't compare a private company that's not sold with these numbers. So you have to be saleable prior to receiving any offer. So there's a big journey to get here, but hey, is it worth it? I mean, even at the bottom of the barrel, 9.7 times your earnings. Think of your earnings last year, not a bad number. Just don't get attached to it. And these numbers are from KPMG's Aerospace and Defense Outlook for 2023. So I'm sure you're probably getting questions, thinking about questions. We'll answer them at the end. So remember, buyers set the price, and when you prepare now, you increase your earnings and you increase the value, which is represented by the multiple. And the multiple is represented by the number of green lights, the fit, the strategic buyer fit or the private equity fit, and the number of X factors that solve that growth problem for the buyer. So the more of these indicators that you have, the better fit you are, the more the buyer is willing to pay to acquire your business. And the corollary is true. Valuation is reduced by red flags. So at first, it looks really good on paper. Strategic fit looks right along what we were looking for. But when they open the hood, there's some inconsistencies. There's some difficulties with the management team. And I'll tell you, these M&A guys, they look at many deals. They ask the same questions. And like me, you've seen many, many companies. We know instantly when there's an issue. And so it's easy to walk away and say goodbye. And so there's no value. So it doesn't matter if, a valuation expert said, hey, your company's worth 10 million. There's no value if there's no buyer that's interested in acquiring the business today for that value. So you always want to be in saleable state if you want to play the game. If you always want to be in saleable state, you're always going to be growing to the next level. So you need to learn to see your business as investors would. Where are the red flags? Where are the green lights? What are the X factors that are going to help us become exactly what our ideal buyer is looking for? And amplify the X factors so you can become that smaller niche, really critical piece of their ecosystem. And then you can solve the ideal buyer's problem. So here are the buyer's top red flags. And this is starting to train you to think, to see your business like they do. So, inadequate growth plan. And management's not a team. That's probably one of the bigger problems that becomes very apparent the minute they start talking to you. And so it's the tone of how the team talks to each other, the communication, how well things are written down, documented, lessons learned, how decisions are made. And the trends of how well your company is growing show how much demand there is for what you're offering. And if there isn't a steady demand trend, then there's issues about whether you're paying attention to what components of your business are actually driving demand, what your unique selling proposition is, what things are you winning the contracts that you need? Are you solving the problems for your customers in a way that brings them back? Not just because you have a great product and service, but it's less hassle to work with your business than other competitors. So these are all the kinds of things that make an investor raise their eyebrows and go, not sure I'm going to do anything about that deal. Information flow is the lifeblood of any growing business. And when you're growing, you always get gaps in the information flow, and being able to solve that scale up problem and recognize that your scale up is having a seize up is crucial, because then you can keep going and that'll stop the bumpy wave pattern in your trends. So that's some of the issues that they care about. So here's the 5 essential secrets to play the right game at the right time. And of course, you're getting the replay on this so you can read the fine print. But you need to play the blue ocean game. Blue ocean is looking at where your great strengths, your innovation, and where competitors are, and making sure you play in a way that doesn't attract more competitors and that's unique to you and hard to replicate. So this is one of the things that we help you understand. You get your team involved in solving the growth problems. People always think, oh, if I tell my team I'm going to sell, they're going to leave. Well, no, this is about growing to the next level and becoming attractive to potential strategic partners that could eventually become your ideal buyer. And so get them involved in solving the growth problems, and it's not all sitting on your head. Then you're working collaboratively to find the scale up issues and fixing them. And that matures your management team into a self-responsible group so that they're spotting the very things that are getting in the way of your business growth. We always say all decisions serve the best interests of the company. Take the shareholder decision off the top priority, take your investor decision off the top priority, and always serve the best interests, because then all interests are taken care of. And when you can recognize the sound of scale up seizing up, and your team is attuned to that, everybody's working to keep that growth trend moving in one direction. It's fascinating how when we work with the team, how quickly that happens. And then you're not feeling like you're dragging everybody along with behind you, wishing they could be more self-responsible. And the last component is, this is your baby. You started this with a very strong vision, very strong why. It gets you up in the morning, and it's your motivation. So selling your business can be highly emotional, and not only the process of playing the game, but finally signing on the bottom line. So there's a lot of signals to recognize so that you can continue to be attractive and play the game, not without letting your emotions play a role, but with your emotions, giving you the information you need so you solve the issues that create the fear that make it difficult to move forward. Everybody's got fear, and all it is information. So take-home messages: learn to become saleable. It's a journey. We teach companies how to become saleable and how to put your company's interests first. Remember, buyers are super picky, so you don't pick one company, you pick a genre of companies to become what they're looking for. The time to start is now, because to attract more investors, to attract strategic partners, to attract your ideal buyer, all of that takes several years to put in motion, and you want to see it on your financial statements, not the day you have circumstances that suddenly now you have to become saleable because your company has suddenly become irrelevant, or there's many issues, that reasons why companies don't sell, as we saw by the fact that only 18,000 roughly sell per year. The path to growth is also the path to saleability, with a lot more strategic focus. And we have to aim correctly, and we have to solve those scale up problems, and you have to collaborate. Collaborate with your management team, collaborate with your investors, collaborate with people like Joey's Outpost team, my team, to find the next spot where you fit in the ecosystem. And when you're part of the ecosystem, your buyers suddenly put you on the radar, and then you get the call out of the blue that says, hey, we're interested. What do you think? So we make sure that your shareholders, you, the investors, get started on this, and you don't skip any steps. This is our decision roadmap process. We make sure that all founder interests are aligned, and any disconnects are talked about and resolved. Help you all understand your risk tolerance, and identify those red flags, green lights, and X factors that are going to make you a star in the blue ocean world, and make sure that you as a group can make an informed decision to turn your business into a saleable asset. Because once you do, your next job is to discover what that puzzle piece should be, and aim for becoming that ideal buyer strategically and operationally. This is what we mean by embedding those X factors, amplifying them, adding the green lights into your strategic plans, and then doing the work to execute the organizational changes that will get you where you want to go. And we map all this out in a saleability blueprint. And if you also want the help of implementation, we work to make sure that the organizational changes happen, because of course every owner's got other jobs to do full-time, and maybe don't have a strength in organizational change and managing all these projects. So that's how we get involved. So I've talked a lot. What questions do you have?
Hey everyone, thanks for jumping in. Please go ahead and use the Q&A function or raise your hand, and we can get you unmuted and help you ask your questions here. Lorraine, that was awesome. I really appreciate you sharing that.
Thank
One
you.
of the things you talked about, so a question I have is, talk about having the KPI set and systems and processes in place. Are there do people prefer OKRs or the entrepreneurial operating system? Are they looking to see something, or are they looking to see a particular system in place?
Great question. I think the answer is if your ideal buyer uses one specific method and there are, 3 ideal buyers and they all use 3 different ones, your method, as long as you have one, will work. But that's not always the case. There are some industries that tend to gravitate to certain methods for how they do their accounting, how they measure performance, how they track their waterfall forecast, their pipeline. And so the job of aiming is to become cognizant of what it is that they do and mirror that. So that when they come to investigate you, because your head has popped up as a potential acquisition, they can make sense easily of what's going on inside your business because they use the same systems. So great question.
Thanks for that. That's super insightful for us as well.
You're welcome. Other questions? Anybody excited about this idea? Turning your business into an asset you can get a return on investment from. You kind of got to want it,
Definitely.
Yeah, because it's all about making changes and you're already making changes. Why not make this change too, just in case a buyer pops up? As a startup, it's change every single day, dealing with challenge, dealing with risks, knowing what direction to go in. And it's possible that, a buyer could come along sooner rather than later. And yes, you can go along for the ride. You might continue to work for the new owner, or you might go start something else. We see that a lot, or take a break.
Yeah, definitely. Well, it doesn't look like folks are jumping in with any questions on Q&A. I have one more that came up in a private chat message to me.
Okay.
And folks were asking, like, how do they sort of put themselves out on the market, right? You had mentioned a little bit about, hey, letting people know, having a network of folks so people can communicate. Where do they get started?
So if you think that you have resolved many of your red flags and your green lights and you've amplified the right X factors for the ideal buyer, I would start with the business development team and your social media messaging. So say there's 3 companies that are of interest. One of them could be a strategic partner, and setting up, or even 2 of them, setting up a strategic partnership to provide some meaningful service to them or them providing meaningful service to you is a great way to get to know potential buyers. And, dating is maybe an analogy. But when you're working on a strategic partnership, both companies are looking for outcomes. And when you work together, you find out that you can create better outcomes together. That is a signal to their M&A group, if they're making acquisitions, that you might be an ideal partner.
That's super insightful. Like useful.
Thanks, Joey.
Thank you. Okay. I think that wraps up our chat today. Thank you, Lorraine.
You're welcome. Happy to talk to anybody privately about this.
We got a question in. My apologies.
Oh, okay.
What are the chances of finding a buyer as a solopreneur?
That's a difficult one. There are some businesses that can that have developed something and it's a product something and you've made it and you've got business development for it, and just acquiring the product without any management around it will do the job for the acquirer. But it's very specific. And if you are a solopreneur and you want to talk about whether you've got that thing that can be sold without any team around it, let's talk about the pros and cons of that. It's not always the case that you have to have a team, but it's very specific. And again, that's got to solve an ideal problem, and in some cases, it's definitely not going to be a private equity buyer. In some cases, it might be a smaller business that goes, oh, that widget is a perfect solution for a problem that we don't have time to solve. Yeah, we'll buy your tech from you. And that's maybe an asset sale, not an equity sale. Again, the path to that, strategic partnerships.
It's a key answer here. Strategic partnerships for the win.
Yes.
Okay. So now I do think we have cleared out all the Q&A. So I appreciate it, Lorraine. This was super helpful. We will be sending out a recording of this and share the slides as well. So thank you all for attending today. Really appreciate it and are excited to work with you.
Thanks, everybody. Really appreciate your time. And I hope you have good dreams about this topic.
Thank you all. Take care.